Hello, everyone. Welcome back. Today, we're going to talk about why Wall Street hated Donald Trump. Now, when I say Wall Street here, I'm using it as a generic term referring to the financial industry. Okay, so Wall Street hated Donald Trump. You might think that that's a little odd because Trump gave us a nice upward trend in the stock market over 4 years. Wall Street doesn't like that. Okay, that's not very profitable for them. This is very profitable for individuals, right? Because over the long term, this is going to give you a return of between 10 and 15%. Okay, so this is almost like a no-brain strategy. You just buy and hold. You just buy, invest in the market and just kind of forget about it. And usually I tell people don't try to guess which are the best companies. Invest in index funds, right? An index fund is one that basically tracks a major index, like a Dow index fund. The Dow consists of like the 30 largest companies in the United States. So basically, you buy a fund that tracks the Dow, or one that tracks the S&P 500, or that tracks the Nasdaq. Okay, Dow being the most conservative. S&P being in the middle, NASDAQ, which is a little bit more, tech heavy. There's more tech companies in there, being the more aggressive one. Long term, you're going to get Dow about a 10% return, S&P about a 12% return, NASDAQ maybe about 15% return. Okay, so that for most people, that is the best investment strategy. Don't try to guess which companies are the best. Just invest in the overall market. Okay, but here's the thing. Brokerage houses, right? They make their money on trades. So if you're buying and holding, right, basically they're gonna charge you that one-time commission, all right, and then that's it. What they want is traders. They want people buying, selling, selling, buying, and selling. If the market has a nice upward trend, the tendency for people is going to be to buy and hold. If you have a sideways market, right, which is we're very likely to see on the Biden, just a sideways market that's going up, down, up, down, up, down. The tendency is that a lot of people are going to look at that and they're going to say, especially people that buy individual stocks, right? They're going to be like, oh, I bought the wrong company. Let me sell that, buy another one, right? Then a week later or a month later, oh, that company is not doing good. The other one over there is doing good, is doing better. Let me sell these stocks and let me go buy that one. So, them going back and forth with buying, selling, trying to chase the market. The only one that usually makes money on that is the brokerage houses because they're charging you a commission every time you buy and sell. Now, in this type of a market, a sideways market, brokerage houses have a major information advantage, okay? Because here's the thing, usually companies, the value of companies follows information. Okay, so information comes out, and the brokerage houses are always going to get that information first. And we're not even talking about insider trading here, or secret information. We're just talking about the information that companies release to the public is always going to land is going to land on the desk of the brokerage house traders first. Okay, they're going to get it first thing in the morning. They're going to have that information. They're going to be able to make decisions based on that information. Most individuals are not going to hear about that information until maybe late in the evening. So, so the brokerage houses have faster access to information. They're able to interpret it. So, in a sideways market where there's a lot of volatility, the brokerage houses are able to take better advantage of information that's coming out. Now, in a market that's just going upward at a steady rate, the value of that information is less because so what if a company didn't exactly meet its earnings or they lost a patent or whatever. The whole market is going up. That means that the company's value is going to probably go up as well. Maybe not at the same rate. Maybe it'll go up a little bit slower. But it's still going to be up. It's still going to go up. People are going to be less inclined to sell. People will sell, but it won't be as much as in a sideways market, right? Where people are essentially chasing stocks. Okay, they hear something about a company, they go in, they buy it. They're watching it. It's not moving. They see another company, right? It's going up. Oh crap, let's sell here. Let's get into that company. By the time they switch over to that company, that company's stock has already made its move. So you're coming in like at the tail end of it, right? So by the time you get in, it maybe goes in up a little bit higher, then it starts coming back down. So now you're losing money, right? Because it's coming down. Now all of a sudden you see another company that's moving upwards. Some good news came out on that. You call up your broker, you're like, okay, sell here, put me into that company. Well, now fine. He makes us, he sells your stocks, buys that one, and same thing happens all over again. By the time you get into that stock has already made like 80 to 90% of its move based on that information. So you're getting in at the very tail end, and usually what happens is it starts coming down at that point. So small-time investors are never going to profit in the short term in a sideways market. Okay? The best strategy is long-term, invest in index funds, and just buy and hold, just ride it out over the long term, okay? So where are we now? We got a Dow of 30,000, and that's, I gotta tell you guys, the whole 4 years that Trump was in office, I did not invest in any stocks. I thought the whole time that the stocks were like way overvalued, which is not to say that I didn't invest in things. It's just that I chose to invest in other things that, in fact, made money for me at a much faster rate. Like I invested in small businesses. I invested in in machinery and stuff like that. So when you're considering an investment, right, the way you gotta look at an investment, okay, is if I buy, let's keep it simple. If I buy a truck, okay, how long is it gonna take me to make my money back, on this truck that I bought, and then start making money on top of that? So with most equipment, most machinery, most businesses that I would invest in, I basically want to make my money back within 5 years. Okay, if it's something that I think that's really stable, I might go, like, let's say real estate or something. I might go 7 years, right? But I want to make my money ideally back within 5 years. So if we look at the Dow Jones right now at 30,000, right? The PE on that, the price earnings ratio, is 29. Okay, so and here's the thing: all these stocks they give you, they have profits, right? So the profit is basically what you would base the value of the company on, because the value of any investment is based on what it's going to give you back. So with the Dow at 29, with the Dow at 30,000, it would take you 29 years to make your money back. So let's say you invest $10,000 in a stock, right? Right now with the Dow being at 30,000, if you put that $10,000 in, and then that company's paying you, let's say, a quarterly dividend, right, which is basically your share of the profits, it would take you 29 years to get that $10,000 back, right? And then, of course, you still have the $10,000 that you invest in the company. Assuming here that there's no price fluctuations in the company or earnings changes. But this is how I look at a price earnings ratio, right? When I look at the stock market, I look at the market and I say, okay, what is the price earnings ratio? It's 29. The stocks are trading at an average 29 times their profitability. Okay, I want to be at 5 to 7. All right, I don't want to be 29 times that. So that's the reason why I have no interest in investing in this current stock market. The point at which I might consider investing in the stock market is if the Dow came down to about 15,000, right, or started getting really close to that, and the price earnings ratio came down to close to 14. At that point, I might consider investing in the stock market. Other than that, if I have other things that I can invest in, right? Land, equipment, machinery, I'm going to invest in those other things. I'm not going to invest in something that it would take me 30 years to make my money back. So I just wanted to share that information with you guys and the way that I kind of look at this. For those of you guys, for those of you that don't know, my background is accounting. Okay, I was an accountant for many years. My last position was a chief financial officer for an import-export company. But I also have the added benefit that while I was in college, I did spend a summer working at investment companies, right? And basically, there's two sides to an investment company. You've got the sales side, and that's usually when you're thinking about the stockbrokers. A lot of people think that stockbrokers are, buying and selling stocks. Stockbrokers are usually just salesmen, right? They're just trying to, make the transaction for you, okay? Or maybe, at some point, maybe even advise you, So there's the sales side, and then there's the trading side, right? That's where they're actually making decisions what to buy, sell, advice to people. So those are the two sides of a brokerage company. So I did spend a summer kind of like seeing the inner workings of how these type of companies work, or how the financial industry works. Now, obviously, I didn't see the whole thing inside out, but I got a good glimpse of it. The company that I worked at was small enough, right, that I was able to both see the sales side and also the investment side. Because if you work for like a really large brokerage house, right, you might only see one side of it or a tiny portion of it. Whereas if you work for a small company, you can kind of see, okay, I got the salesman here, I got the traders up on, over there, or on the next floor up, and you can go up there and you can kind of see, I was actually able to see how they made a lot of decisions. I learned something about about trends that they look at. They look at charts. They try to look at what they call technical analysis, where they look at patterns, right? They look at patterns based on the pattern, what is most likely to happen. So I have a general idea. The general pattern that I have become familiar with, and that's kind of obvious. Because here's the thing: when you're looking at this stuff, I look for the most obvious stuff, right? Because a lot of sometimes when you have investors, they're looking at this stuff and they're like, oh, look, there's a little move over here. There's a little, it moved. There's a lot of luck involved with that. But the pattern that I've seen, if you look back at the market, going something like 50 years or 80 years. When a stock is, let's say, gets at a high, the best place to start really investing in the market is when it comes back down to about 60%, and that can be from 60% going down to maybe 40%. It really gets down to 40, to this 40%. But what I would do is once it gets down to this 60%, that's when you start buying. And again, I would buy in index funds, start buying there, and then it may continue to go down a little bit, in which case you're going to lose money. That's fine. I would buy again here, then buy again here, wherever it is, and then at some point it'll start going back up. I might start buying it also on the way up. So now I'm starting to average up a little bit, but that's generally what I look for. I want to see like a 60% drop, more or less. I saw that back in like 2008. I saw that again in like 2001. And then there's also, you also want to look at the fundamentals. Remember back in 2001, right after the World Trade Center attacks. Okay, and I was in New York at the time. I remember the day that the stock market opened, because they closed the stock market right after the attack. I think they opened it up like a week later, and I remember Boeing dropped from like $30 a share down to it was like $10 a share. And I thought to myself, you know what? They're not going to stop making airplanes. People are not going to stop flying. So I went to Boeing. I bought a whole bunch of their shares, and sure enough, about a year later, I sold it for about like 3 or 4 times what I bought it at. Same thing. I did something similar back in 2008, 2009. Again, when the stock market came back down. And here's the thing: when you're looking at watching a market going down. A lot of times people say, oh, it's at the bottom, it's at the bottom. Don't even start thinking about the bottom until it gets to about 60% down from wherever the highest point would be. So with the Dow now at 30,000, I'd like to see it get down below 20,000 before I seriously considered investing any money in this stock market. And then I would probably start at 20,000, start buying it down. So I'll invest some money, let's say at 20,000, not a whole lot, just a small amount of money. Let's say 5 to 10% of what you have available to invest. Then invest again at 28,000. I'm sorry, at 20,000, then I invest again 18,000, then invest again, going again at 16,000, going again, at 12,000, and then, just kind of like average down. And at some point, it'll start turning around. And then if you still got money, you can start averaging up. You just keep buying, sooner, eventually, at some point in the future, it is going to come back. And that is probably the best way that you can actually make money on this. Wait until the market actually comes down. This 60% bottom is probably a good goal to have long term. So hope you guys enjoyed this video. If you're not a member, please subscribe. I'll talk to you guys next time.